Good morning, and thanks very much for the opportunity to share some perspectives with you. We saw from the previous paper there were many, many numbers in that paper. Mine has none, so it should be a good complement. So let me just provide a little bit of background as we go through. The title of the paper is A New Insurance Supervisory Landscape, Implications for Insurance and Pensions. The work here is very much sort of survey and assessment of the regulatory landscape and impact on retirement security and pension security. I'd like to just outline some of the themes before we go into the details. Post-financial crisis, many new supervisory and regulatory structures have been formed at the national, regional, and global levels. There's been a focus on improving elements of social welfare post-crisis, alluded to earlier, financial stability and consumer protection of conduct being primary among those two. There are very important unresolved issues around both supervisory structures and the new policies that are being implemented. There's uncertainty around objectives. Supervisory ambiguity, redundancy, and conflict is very present in the system currently. As a result, both of the policies and the supervisory structures, there are important unintended collateral consequences that I'm going to outline that we need to be mindful of. The system is currently very unsettled. I'll also identify some of the ultimate effects on social welfare, which are meant to be multidimensional with trade-offs. It's frequently ambiguous in the sense of the proximate effects can be very different from the general equilibrium effects. And then there are follow-on impacts for pensions, efficient risk-bearing, and retirement security. So the structure of the paper, and hopefully get a chance to breeze through it. First, I'll provide some information on what is the current supervisory landscape, what are some recent developments, so a bit of level setting. Secondly, I'll talk about some of the feedback effects that occur from the implementation of policies and the ways in which they have an effect on market structure, conduct, and performance. That then determines the ultimate effects on social welfare dimensions. And I'll provide many examples in the paper. I'll go through a couple today because there isn't enough time. But elements around financial stability, capital fungibility, mobility, the trade-off between product risks and provision of product, consumer protection and market coverage, some of the trade-offs there, and issues around the treatment of risk weightings for sovereign debt and systemic risks that flow from that. The effects on pensions and retirement security has to do with the efficient allocation of risk in the economy, in particular, addressing retirement risks of longevity, investment protection, and income generation, and I'll provide some opportunities for improvement as well for the system. I wanted to provide a little bit of background on the source of the perspectives that I'll share with you today. So just two slides, if you could bear with me for a moment. It's drawn largely from the work with my firm Tapestry Networks. We run multi-stakeholder networks between private sector leadership, typically at the board level and chief risk officer level, along with leadership of important policy organizations. We have practices in finance, healthcare, and corporate governance. I work in the finance area. And specifically, the perspectives I'll share today are drawn from the operations of the Insurance Leadership Network. I'd like to say just a few words about this network. So this page, this map, shows you the participating organizations, both from the private sector and policy community, by geography, and it's grown actually from this point. We have roughly the top 20 to 25 largest global, most complex insurance organizations in the life space, P&C space, and others. The participants from those insurance organizations are board directors and chief risk officers typically, with other executives sometimes participating. We also have the policy leadership of the organizations represented, and particularly it tends to be executive directors, secretary generals, and presidents of the policy organizations. And then we have a variety of thought leaders who join us as well. The scope is global, although there's a concentration in North America and in Europe. Examples of participating policy organizations include, and many of these are mentioned in the Wall Street Journal article that Olivia alluded to, the Federal Reserve in the US, both the DC Fed and the New York Fed, the National Association of Insurance Commissioners, the Financial Stability Oversight Council that designates systemic risk within the US, and then many participating policy organizations in Europe. As an example, in the UK, we have the Financial Conduct Authority and the Prudential Regulatory Authority, but many of their counterparts in continental Europe as well. IOPA, which is the European Insurance and Occupational Pension Authority, the Financial Stability Board, and the International Association of Insurance Supervisors, which you'll see in a moment, are very important for development of global capital standards. We run meetings, 6 meetings per year, alternating between London and New York. It's very much a heads-up dialogue, roughly 20 to 25 individuals in the room for anywhere from half a day to 2 days. and it is private sector and public policy community working together on shared objectives around implementation of policies and the effect on markets. So what does the system look like today? It's relatively new since the financial crisis. This is the supervisory landscape system. It's roughly nested, which I'll describe. It's complex, it's overlapping, it's interdependent. There's been a lot of activity since the financial crisis. The policy issues are focused on prudential issues of solvency and stability, as well as conduct and consumer protection. As I mentioned before, there remains a lot of ambiguity, redundancy, and conflict in the system. In particular, the advancement of policy objectives, but then colloquially, who has the ball on those issues? Who has the responsibility and authority to push things forward? The nested structure it's shown is there are national authorities within Europe. So the top large box, you'll see the Conduct Authority and Prudential Regulatory Authority for UK, Germany, France, Ireland, Switzerland, the Netherlands, most of continental Europe and UK. Wrapped around that is the IOPA structure, which helps coordinate all of the national authorities within Europe. The US system is more complex and more cellular, so it starts foundationally at a state-based system. So you'll see the bottom of the page, each state has its own insurance commissioner overseeing the insurance industry, which is a relatively unique structure. There's then the National Association of Insurance Commissioners wraps around the state. The NAIC has, many of its policies they act in a non-official capacity, but they do certify US states and represent the US in some international dialogues. There are then important new actors on the scene, including the Federal Reserve, which oversees insurers that have bank holding operations, those designated systemically important in some international firms. The Federal Reserve currently oversees about 1/3 of all insurance assets in the US, which is a new outcome. The Federal Insurance Office, which is newly created under Dodd-Frank, part of Treasury, not formally a supervisor, but has significant influence on the industry and represents the US in international dialogues. And then importantly, you'll see wrapped around the entire structure is the Financial Stability Board and the IAIS. These organizations, the FSB is relatively new. It's based on the G20. Since the financial crisis, it's focused on developing and implementing common standards around capital supervision and financial stability, in particular the designation of systemically important firms. So how does the system work? Each of the policy organizations is advancing its own policy objectives. There's certainly a degree of coordination, but there's some insufficient coordination that occurs. The policy community is advancing objectives around solvency, so Solvency II, which include accounting standards, valuation methods, which we'll hear about later today, I think. Financial stability, so the designation of systemically important firms both locally and globally, and the development of capital standards that then layer on top of the systemically designated firms. In particular, there's specific treatment around so-called non-traditional non-insurance activities, which includes many forms of annuities. So this can have an effect on the attractiveness of the participation of some of the largest providers of annuities in the annuity market and can influence the degree of competition, provision, and price competition for annuities. We'll hear more about that. Also advancing goals around consumer protection and conduct, governance for group supervision and subsidiary supervision. The private sector responds to these policy, implementation of these policies in making decisions around product design and pricing, customer selection and targeting, geographic presence, investments, asset allocation, and organizational structure and domicile. There can be very important differences between the proximate effect of advancing a policy goal and the ultimate effect on markets after some of the private sector insurers have responded to those changes. And when assessing the effect on social welfare, it's important to look at the general equilibrium outcome as opposed to the proximate outcome. This dynamic is a very important topic and source of dialogue within the insurance network. It occupies at least half of our meetings. The way in which those two elements interact then determines the effect on social welfare. A couple things to note here. As policymakers pursue their objectives, they'll advance one element usually of social welfare, but it will have effects on other elements of social welfare. So financial stability, consumer welfare, including prices, market coverage, and quality of products, as well as solvency, have been the primary policy focal points for a number of the new supervisory organizations. There are trade-offs across those three, and they also have collateral effects on the degree of macroeconomic growth and adequate returns to capital. And so you can see effects that show up in capital markets, in the performance of industries, in the growth of economies as a result of the pursuit of some of the policies. So there's certainly benefit from greater supervisory coordination, both on the policies and the way in which the system is arrayed. What are some of the challenges? What constrains the system from taking a broad view of social welfare? And I've tried to identify several of these. Certainly, there are new regulations on unsettled supervisory landscape in motion. There are also important trade-offs between social welfare dimensions that are not always known, acknowledged, quantified, or incorporated. There are limitations around geography. So it's practical that most of these organizations have limited geographic scope. The implications of some of the policies may lie outside their geographic scope. The policy mandates are necessarily narrower sometimes, so one organization will be focused on conduct, another is focused on financial stability. As they each pursue different objectives, they have collateral effects on each other's outcomes. The side effects are frequently uncertain, unquantified, and lie outside the scope of consideration. One way to advance the system here is to focus on so-called Pareto efficiency. In other words, is it possible to improve one element of social welfare without decreasing other elements of social welfare? And I think there are opportunities like that in the marketplace today. I'm just going to touch on a couple specific examples of how some of these trade-offs play out to give you a sense. The rest are in the paper. In each case, there's a pursuit of a policy benefit, and there is real gain from achieving the policy objective. However, the issue frequently is that there are collateral effects around policy design, scope of authority, unintended consequences. One of the first issues is around financial stability and capital allocation, capital standards. Here the issue is as an example, there are SIFI designations or designations of systemically important firms at the local level, the global level. So FSOC does it within the US. The Financial Stability Board does it globally. It's somewhat coordinated but not completely coordinated. That then has implications for higher loss absorbency capital requirements. The FSB is developing global capital standards. There's local ring fencing of capital. So individual subsidiaries within countries are required to be locally solvent and capitalized, which can increase capital intensity. The outcome is very high levels of financial stability and solvency. I would say extremely high levels of financial stability and solvency as a result of higher capital requirements for the SIFI designated firms. The trade-off is higher capital intensity comes with a cost. When reduced fungibility, there are higher cost structures, reduced price competition. There's potentially some withdrawal from product and geographic markets and lower returns to capital. So all of that can be tolerable, but it should be acknowledged and incorporated into the policies. Another area is around product risks and provision. Here, the policy action is enhanced capital charges for some types of products, especially types of annuities with guarantees, which helps to ensure solvency for the product. But it's also connected to the SIFI designation and the higher capital requirements on so-called non-traditional, non-insurance activities. The outcome, again, can be enhanced solvency status for specific types of products and insurers, but for those insurance companies that have been designated systemically important, they may choose to withdraw from these markets significantly, both by geography and by customer type and by product feature. A third example is around resolution methodology and capital efficiency at the bottom of the page. Here the policy action is for systemically designated firms, there needs to be a plan around the resolution recovery of the firm if it encounters financial distress, which is a good idea. But because supervisors in different geographies cannot coordinate their efforts very well, they require that each subsidiary be locally capitalized, which reduces capital efficiency tremendously. So you have enhanced resolvability, improved financial stability, but you also have higher capital intensity, higher costs, higher prices. I'll speak to two more. Another area of trade-off is regulatory policies and investment pro-cyclicality. So here, the policy action is to require more accurate and timely balance sheet representation of assets using something closer to mark-to-market valuation methods, and we'll see more about that. The outcome is that balance sheet is better reflects current capital market conditions. The trade-off and the drawback is that insurers typically have long holding periods relative to short-term fluctuations in capital market pricing. So current capital market conditions may have less relevance for value at maturity in the holding period for insurance organizations. It's possible that insurance organizations may be then motivated in their investment behavior to do things that amplify capital market volatility, force asset sales during periods of distress, and cause insurers to move away from more volatile investments in situations where they would otherwise be solvent. The final example here is on risk weighting applied to sovereign debt and systemic risk. The policy action here is to apply zero risk weightings on sovereign debt assets across different sovereigns despite differential risk recognized by the market. It shows up in capital market pricing. The outcome is the supervisors avoid the political implications from differential risk weightings on sovereign debt, but they enhance the likelihood and speed of standards adoption. The trade-off is that insurers can be motivated as a result of regulations to invest in higher return, so-called zero risk weight sovereigns. It strengthens the connectedness between financial institutions and domestic debt markets and creates greater potential for instability. This is actually an area where policy action may increase financial instability rather than decrease it. Advance forward. How can it be improved? Opportunities for improvement. Improved supervisory coordination through supervisory colleges, the creation of observer roles, cross-advisory roles in different boards across supervisors. This is being done to an extent, but not sufficiently. Currently, supervisory colleges and coordination have been information sharing rather than policy coordination. Policy clarity is another example, area for improvement. Specific objectives and rationale can be articulated better. Proposed policy rules can be crafted with some delay before implementation, with comment periods, acknowledgement of touch points and policy trade-offs. Some of this is being done, but not enough. Improved understanding of outcomes through industry dialogues, expansion of practitioner panels at the supervisors, and a commissioning of studies to identify and quantify some of the effects of policies. And finally, why does it all matter? I've alluded to several of the effects on the provision, competition, pricing, and features for annuities with guarantees. In particular, the development of new capital standards and the treatment of annuities as product categories could have a debilitating effect on that market. Capital market performance can be influenced through higher volatility, less liquidity, lower returns as a result of different behavior by insurance companies in capital markets. Insurance companies plus pensions combined control $50 trillion in assets across the globe, have a big influence on capital markets. There's important work that can be done on the influence of some of these dynamics on the transfer of longevity risk, which is an important issue going forward, as well as pension settlement strategies. So I think good quantitative research to be done here. Just wrapping up, insurance regulation and supervision is very much a system in motion. There are new regulations that are being finalized, implemented, and refined. Simultaneously, there's a new supervisory structure that has a degree of ambiguity, redundancy, and conflict in it. There's a lot of good work to be done to improve the system. In the short term, there are significant immediate effects on social welfare. So hopefully this is a helpful construct with which to view some of the issues. Thank you.